rate of return on real estate equity is always zero. In this episode, I'm going to answer the question, how to calculate return on real estate investments. Get ready because you're going to be blown away with some insights that maybe you have never had before regarding real estate equity. But I'm going to give some actual examples of how you can calculate your true rate of return. So my name's Doug Andrew, and I've been a financial strategist, a tax minimization specialist for more than 46 years. And I've written 11 books so far. I'm going to keep writing a book every year. The rest of my life is my goal. But many of my books address this very topic. And so when people come to me that have acquired a lot of real estate and what have you, they will ask, well, how do I really calculate my rate of return? Now, I first say, are you talking about on your real estate or real estate equity? And they think sometimes that's the same thing. No, it isn't. So let's get clear. The rate of return on real estate equity, in my opinion, is always the same. Zero. Nada. Okay? Now, let me explain that, and then I'll talk about how you really calculate the rate of return on your real estate, because the return on the equity in the real estate is always zero. Now, when you have equity that begins to accrue in real estate, or if you pay a big down payment, or you take a lot of cash from the former property and you put it into the new property. See, most people think that you have to take the equity out of your previous property and put it into the new one to avoid paying a capital gain tax. No, the IRS has never required that. You have to buy a like property of equal or greater value. I've never taken one dime of equity from my former property when I sold it and put it into the new property. I just bought a new property and I kept the equity safe, liquid over here. Now, when I say over here, I'm talking about my right-hand pocket. That's my assets. Where do I keep my cash for liquidity, for safety, for predictable rates of return and tax-free? It's what I call my laser fund, because laser is an acronym that stands for liquid assets, safely earning returns. And over the last 46 years, I have averaged 8.2% tax-free. The last 25 years has actually been as high as 10.07%. We'll just use 8% in most of my examples here. And so when I keep my money over here, liquid and safe, compounding at 8% tax-free, and I've been doing that, again, for 46 years, and my real estate over here, I am using OPM, other people's money, just like banks do, where I am borrowing money to buy the property. And I pay a mortgage on that, and if it's rental properties, real estate investments, usually the interest rate is a little bit higher than my house. I can borrow on my house right now at the recording of this video for 3%, tax deductibles, a net cost of 2%. On the rental properties, I may have to borrow at 6%, but it's still tax deductible. In a 33% tax bracket, it's only costing me 4% after the deduction. Because on $1 million of real estate, if I owe $1 million on a mortgage, at 6% interest, I'm deducting $60,000 of interest. And in my tax bracket, I'm saving 33% of $60,000 or $20,000. So the net cost of a 6% deductible mortgage, because I can deduct it on Schedule E or the LLCs, however I own the real estate, is not 6, it's 4, okay? And I can earn 8. How much more is 8 than 4? It's 100% more. Every million, I pay $40,000 and I make $80,000, and that's just the first year. If this keeps compounding, it gets better and better. This is a simple interest formula. This is a compounding formula. But the very first year, again, it's like I would very gladly pay an employee $40,000 that made me an extra $80,000. I'd buy a widget machine for $40,000 that made me an extra $80,000. That's what you're doing. This is how money really works. But if you sit there and you pay extra principal payments to the mortgage company and you put all that money into the property and it goes up or down in value, it will do that regardless of how much you owe or how much equity you have. It has nothing to do with equity. The rate of return on real estate equity is always zero. Your house will go up or down regardless of whether it's mortgaged to the hilt or free and clear is what I'm saying. If you don't understand this concept, be sure and search on this YouTube channel for me doing the pitcher and the goblet working metaphor, and you'll understand it better. But let's move into calculating the rate of return on the real estate investment, because the return on the equity in that property is always zero. So let's start with the simple way to calculate. Perhaps you can use the rule of 72. If you don't understand that rule, if you're wanting to see how long it will take for your money to double, you have a lump sum of money, okay? Let's say $100,000, and you are earning 8 or 9% or 5%. You divide that interest rate into the number 72, and it tells you how many years it will take for your money to double from $100,000 to $200,000. So at 8% interest, 8 into 72, it will double in 9 years. At 9% interest, it doubles in 8 years. At 7.2% interest, it doubles in 10 years. At 10% interest, it doubles in 7.2 years. You got it? Well, when people would say to me, hey, I bought a piece of real estate for $100,000, and I just sold it for $200,000. I doubled my money. I'm not impressed until I know what. Okay, did you leverage or did you pay cash? If you paid cash and you say, well, I held on to it for 10 years, I go 10 into 72 is an average of 7.2% return on your money, I'm not that impressed. I don't care if you doubled your money. If it took 10 years, 10 into 72 means you only got the equivalent of 7.2% rate of return or appreciation. So you can use rule of 72 to calculate sort of what your rate of return is on a simplified basis. Or you can use a calculator based upon, if you haven't doubled your money yet, what the rate of return is. But one of the examples I want to use is a story of a couple in Palo Alto, California. And if you do own real estate, you know one of the secrets is location. Location, location. So listen to this story and learn from what they learned by having all this equity tied up in their property. This couple, 40 years earlier, bought a 6-bedroom home that they raised their 6 children in, and they bought it for like $230,000. And they had continued to make improvements and so forth. But over 40 years, that house kept increasing in value. Now, in the San Francisco Bay Area, real estate is wacky. So let me explain. When they retired and were empty nesters, that 5-bedroom home was worth $4.8 million. Okay? Now, at $4.8 million, they were thinking about renting it for a while, and so they rented it for $10,000 a month, and they were at first going, look at us. We are renting this for $10,000 a month. Now, some people gasp when I say that, but that's very typical in the San Francisco Bay Area, especially for a 5-bedroom home. That is pathetic. Why? We showed this couple that there are 5-bedroom homes all over in America, like Memphis, Tennessee, or Orlando, Florida, that cost $300,000. Same size home, newer homes, and they rent for 1% of the value of the home a month. Okay, they rent for $3,000 a month. That's worth $300,000. It rents for $3,000 a month. Now, when you do the math, that's $36,000 a year. It's an annual return of 12%. Okay, it's 1% a month. This couple in California renting out their house for $10,000. $10,000 times 12 months is $120,000 on a $4.8 million asset. That is a pathetic 2.5% annual rate of return. That's ridiculous. So what does that tell you? Either that house is way inflated, it is really not worth $4.8 million, or if that house was like homes in Memphis and Orlando, it should be renting for $48,000 a month, not $10,000 a month. So what did we do? I'll share with you what we did to quadruple their cash flow and get a new house free and clear. So this couple sold the house. They were able to do 1031 exchanges on 13 other homes in Memphis and also in Orlando, other cities where the rent multiplier is 1% a month. And they also had excess cash of $800,000 to buy a house twice that size in a retirement community, okay, where real estate values were more realistic. Now, with 13 rental homes, they have more than quadrupled their cash flow. They have 13 homes now, each worth $300,000. These are newer properties. They're appreciating better, but they're able to experience net rental income of $40,000 a month. Hello? They went from $10,000 a month to $40,000. That is 400% increase in rental income, and they have newer properties, and they still have a house to live in that's twice the size of their previous house. We were able to take lazy idle equity out of an overinflated house in San Francisco Bay Area, because it's going to correct someday, and we were able to accomplish that for them. Now the rate of return is way greater. It's more like 10 to 12% a year on cash flow. And whatever the properties appreciate at is gravy. So the way that you calculate rate of return on your real estate is you look at two factors. If you're renting it, you calculate what is the actual rate of return, or what I call the rent multiplier if you're renting it. And you can dramatically increase this by maybe fourfold like this couple did. But also, these properties are going to appreciate. Based upon the appreciation in Memphis and Orlando, those $300,000 homes will be worth $450,000 to $500,000 in as little as 5, 6, or 7 years. And so you add on top the appreciation on top of the cash flow. And most of our clients that do this end up at the end of the day with more like a 20-24% average annual rate of return on their money when they turn it over or they sell it 5, 6, 7 years down the road, because we calculated the cash flow rate of return and the appreciation. And we did that by keeping the properties mortgaged to the hilt. This couple kept their equity, their cash, that they didn't tie up in down payments at 20% over in their laser funds, and were able to compound that money and earn a rate of return twice what the net cost of the mortgage was. It's unbelievable how much more you can earn when you manage your real estate equity, and you just don't send extra principal payments or the rent payments against the mortgage to hurry and pay it off. So if this is intriguing you, I would encourage you to subscribe to this channel and also search. I have dozens of other educational videos that talk about real estate equity management and also how to manage your money, keep it liquid, safe, earning predictable rates of return, compounding tax-free. You will learn about what the laser fund is, and you'll also be able to get a free copy of my most recent best-selling book, The Laser Fund. You can go to laserfund.com and check it out. But learn, empower yourself, and watch this episode next.